Yo, sir.
Yo, here's a link.
Yo, sir.
Yo, here's a
You have
link.
the sneaky link.
This
Yo,
thing.
sir.
Uh, how does it look on your behalf? Not too bad, at least, hopefully.
See. Yeah, no, not too bad. Things look a little stretched out vertically.
Yeah. Well, I'm on a almost 40-inch monitor, so that's in 4K.
Yeah, if there's a wait, let's see.
Well, it's what I put on OBS. It's the settings I have. Yeah, I'll change it to.
Gotcha.
I'll stop the. Honestly, it's not too bad.
No, it's not. Yeah, try bringing up a graph or something.
Honestly, it's not too bad.
What's the definition at right now? No, it's not. Yeah, try bringing up a graph or
Like
something.
1080p or 720p.
What's the definition at right now? No, it's not. Yeah, try bringing up a graph or something.
That graph isn't really too. I'm working on that.
Yeah, it just doesn't. Maybe it's my phone. Let me see. Oh yeah, it is. Okay.
Is it?
Yeah, because my phone was at fucking 360p. Yeah, okay, that's very. Oh yeah, it is. Okay.
Is it?
Yeah, because my.
All this data, Christian. Can't hear me.
Gorgeous.
Okay, cool.
Hey, just make sure you're not displaying any of your personal info there.
Definitely not.
So right now, everyone in the stream, they can hear our Discord call too.
Yep.
What?
Next, Dow Jones's ticker symbol.
I think you just do. It's a DIA.
Like people are tripping about the drop, bro. Look at the Dow Jones Industrial Average from a freaking from the maximum, bro. It's up 1100%.
Probably. I always look at like the kind of. I'm always looking at the past 4 or 5 years. And I know you have everything that happened with COVID, so it's kind of hard to analyze 2020, 2022 when we had those huge you know kind of drops in the stock and the overall stock market.
Yeah.
Um, but even so, like even over that time frame, it's the overall market's still up. Even considering kind of those abnormalities.
Sharing my screen too, so if you wanna, I'm doing, just.
Oh, I'm watching on the
Oh,
live
okay,
on
cool,
the
cool.
live stream right now.
Yeah, yeah, yeah. Right now, it's just bro, S&P 500 from a long, but oh my God, this drop's crazy, bruh.
So talk a little bit about how standard deviate like using standard deviation can be helpful as a trader.
Yeah, for sure. Yeah, so this data that we're seeing on our screen right now is really past 25 years almost, is from I think 1999 or 1998. Um, and this is without any data manipulation, no normalization, none of that. This is just straight up a histogram, and the bins are essentially by 0.5% differences. And it goes to the negatives and the positives, like negatives on the left, positives on the right, and you see a natural bell curve fit essentially. So when we put that on an actual standard deviation bell curve, we actually see a nice little fit. And then not only that though too, if we see that nice fit because due to sufficient data and there's no null values, there's no random stuff in the data, we actually kind of have a pretty accurate standard deviation graph here. That's pretty cool. Having enough data is definitely important to creating standard deviation because if I were to run the same, I have a script that allows me to run the same data except for it's just for the past 6 months, you actually get a different picture. You're actually going to get a graph that any mathematician will tell you, hey, you need more data or something's fishy is going on. See this the fact that this graph doesn't necessarily fill out like the last bell curve actually. It does not, and this is because this is just data from the past 6 months. So what do you expect? You're not gonna, honestly, if we were to look at the data in the past 6 months, we're gonna see 2%. That drop that was crazy. If I look up the SPY right now, actually, if I look at it from the past 5 days, you're gonna see a barely 5% drop. Let's see in the past month, yeah, 6%. And then you have gains after 1 month. The maximum we see is a 6% drop. So this data would even be more skewed towards a negative point of view. So that's why it's important to look at it from a long-term point of view. Um, because the data is not even full. It's not even. But yeah, besides that, once we can confirm that we have an accurate standard deviation graph, we actually can then kind of rely on the statistics from the standard deviation chart that we see in general. So, when you look up when you're looking at a standard deviation graph files, you can we can see the probabilities of each standard deviation occurring. So within standard deviation 1, positive or neutral standard deviation 1, we're getting almost a 68% probability of that movement or that range occurring. After that, we have a 13.5% for both -2 and +2. And then for the +3 and -3 standard deviation, we have a 2% chance of that occurring. So
Now to clarify too, this is not a predictive model. This is simply just a historical model.
yeah, this is just this is basing yeah, this is all just looking at data from the past 25 years and basically ranking the data from the past 25 years. This is not like yeah, yeah, exactly. Good point.
Don't worry, I know this stuff. I'll be asking questions as if though I don't. Gotta keep it high level for the normies, you know.
100%.
Um,
The numbers are important, but honestly, what's really more important in my opinion is making sure you stay up on news in general. Uh, because if you're not staying up on news, you're gonna get sideswiped pretty hard. When one day you try to sell a spread or you try to do something based off of numbers and math, and the Fed decides to have a meeting and tell everybody that they're not lowering the rates. Oh, you're cooked. You're done. There's been times when I was so focused on the numbers, I did all the DCFs, all the valuations, all that stuff, and I buy a company and I literally just let it sit. I forget about it. I'm not even considering how they've been doing for the past few months, their market share, their upcoming Q3, Q2, Q4, their next annual statement. I wasn't even considering that. And so it's important to consider all the news besides just looking at the numbers. So let's just say if we look back at our graphs, we're going to see that our standard deviation for the SPY is expecting it to have a $3, $4 range for standard deviation 1. And the reason why we can't rely on that is because we don't know what's going to go on.
I hate to cut you off. I'm not seeing anything on the stream right now.
Yeah, I'm not showing any data. I'm kind of just yapping
Oh,
at
okay.
this point. Yeah, yeah, for sure. Um, but really, it's really the real issue is the fact that if we try to just look at the data, like this was data from a few days ago. We could see that the mean was supposed to be 532, and the standard deviation 1 for the negative is going to be 531, and the positive is going to be 534. That's a $3. That's almost a $3 range, and that's why it's not important. You can't just rely on the numbers. If you just go relying on the numbers, you're going to get cooked. There are scripts, there are things you can do to automate that ability to look at the data, look at news, you know. There's a lot of macroeconomic indicators that provide. I think there's something called the fear index actually that I heard that it basically averages or something like it does something with the S&P 500 and the news that you hear online, and it's called a fear index, I think. Oh, the fear and greed, that's what it's called, the fear and greed.
There's the fear and greed index, and there's also the VIX as well, which is
Yeah,
another
yeah.
way of measuring.
Volatility for sure. For sure. I'm a real fan of something like this though because even though the SPY doesn't necessarily function off of, if this stock does or if the government does this, if the government is that, if this happens in the world, but I think it's a look at this 5-day average put call ratio. This is pretty cool stuff right here. Options or contracts that give me, yeah, you're just gonna give me basic information or what ratio of what is considered. Puts. Oh wow, this is a cool little graph. This is a puts to call ratio graph. So when the graph is going up in value, that means there's more puts. When the stock is going down, that or when the graph is going down, that means more calls. And when you have a rise in
Yeah,
puts,
I'm not sure what graph you're referring to. It's not on the live stream.
what? Wait,
Yeah, that's what I was
you're
saying.
telling me you can't see my computer screen right now?
I mean, on Discord I can, but not on the live stream.
Wait, it's gonna take a second for it to. It's not 100% instant, so that's something to
No,
consider.
no, it's just like a blue screen right now.
Huh?
Like, yeah, I don't know what's up with it.
Here, refresh your page because I think your thing may be tripping slightly. No cap. What are you seeing?
Maybe bring it up again. Um, okay, there we go. It's back. All right, we're good.
I'm gonna get a cup of water in 1 second. Get low.
Yeah, I'm still here.
There's honestly a plethora of things to look at when looking at the market, but I think one thing that I learned specifically from if you look at the 2008 crisis, and you look at the guy who kind of helped predict it, name having a
Oh,
brain fart.
Michael Burry.
Yeah, Michael Burry. I'm having a brain fart. So the key with him is that he was really focused in on mortgage rates and all that stuff. He was really not only was he considering basic stocks, he was considering macroeconomic indicators, but then he was really looking to the books behind a lot of these mortgage and real estate companies. And so if you kind of want to predict like a dip or a rise or anything like that, you kind of have to pick something that you know about that you have an interest in too. So that's something to consider too. Because if we were to look at, so if we're looking at the market from an objective point of view, like from a wide point of view, it's going to be whatever. But if we start looking at the market from the perspective of Apple, tech companies, and all these companies, however they've been doing, I know a few of them have been releasing their quarterly statements. We saw Intel get smashed in their Q2, Q3, whichever one they just released. So just imagine how these other tech companies are doing, especially when you have interest rates, right? When you have yields, when you have corporate bond, like a company like Intel is a negative A um, rated company. So and they're bottom of the barrel. So yeah, so anybody above them is probably going to be an A plus, an A, triple A bond. So when you have triple A bonds going up, you have top 500 companies in America suffering. And so it's just when you and I could pull up that I'll Google that. I'll look at that graph right now. If we look at yeah, if we go to Fred.com, if we look up AAA, we're gonna see Moody's season corporate bond yield is one of the most popular bond providers. We're gonna see that rates have just been fucking rising. Yeah, you're getting a tiny little dip right now, but it's uh it's definitely up from 2022. It took a dip from 2023. Maybe that honestly, if you really consider this dip from 2023 and just little fakes, really get to see the story. I feel like you know markets the AAA bond yields in 2023 were going up or skyrocketing, the highest they've ever been, and then they took a dip in January 2023. Kind of explains a lot of the bull market that we've been seeing. And then as of today, it's actually shrinking back down to almost it's actually getting a little lower. It's actually not too bad.
Well, yeah, because treasury yields are going to start falling a little bit, and when they do, people are going to move their liquidity from bonds back into the stock market.
Good point. That's actually an excellent point.
Yeah, because there's always that push and pull relationship between the two of them. Same thing with like what we're kind of seeing now as well. Similar to between the relationship between the stock and the bond market, you're kind of seeing something similar with the technology stocks, technology companies, and the blue chip companies, where people might not be so excited about technology anymore. They want to move their cash to more mature companies.
No, definitely. But then at the same time, we have um, people in Myanmar, which is a country, Gen Z, our generation, a country neighboring Bangladesh and Thailand, fighting for essentially they had a coup where the government takes over, and so now you have the People's Republic or a bunch of ethnic groups and a ton of freedom fighters essentially joining forces in order to defeat this government. That's also supported by certain groups, part of bigger things like IDF and the United States and China, Russia, etc. And then you have what's going on in Russia and Ukraine, and then you also have what's going on in Gaza and Israel. So you have honestly you have some things going on in the world that honestly, the only companies that should be making money right now are freaking weapon and defense companies. But then at the same time, you have Nvidia, you have the AI hype, you have I feel like just a lot of capital is stretched right now. So these pullbacks are not nothing to be shocked by. Like I'm not shocked. I've seen every company, bro, Kava, the company that makes freaking that's trying to compete with Chipotle in food bowls, has been going up. That's millions of dollars, dedicated to that stock. Then you have Nvidia, that's billions of dollars dedicated. You have the capital of the world being spread out. So that's something heavily to consider. I think right now we're doing a pretty good job without limiting or producing more money. It's AAA
Yeah, I
bonds,
think that's something that
huh?
I think that's something people really forget is that, people are going to put their money where industries are growing. Like it could still be good companies like industrials, the
Sorry.
industrial industry, the financial industry. I mean, those are all very financially solid industries, but it's just not where the growth's at. So people aren't going to be pouring their money into those kind of companies.
As you say that, I'm about to run some statistics right now on currencies, just to take a sneak going on with currencies and America's partner. So I'll get you that. But that's something I'm
I
interested to
think
see.
I'm,
Currencies.
yeah, you take a look. I think I'm going to head out and get ready for my meeting that I have here.
I'll see you later, bro.
It's good run through. All right. So yeah, take care. All
That
right.
was fire. Have a good one. Peace, peace.